I want to turn my attention to markets right now. Very pleased to have with me Neil McIver, founder of McIver Capital Management at CG Wealth. Neil, appreciate you taking the time for us. And I thought about you the other day in that looking at, obviously we look ahead to 2023, but I'm looking back at 2022. And I loved a piece of the advice. You were very cautious in 2022. You had a big cash component. You kept talking about, you were worried about the rise in interest rates. That list, you had a pretty darn good list. In my opinion, doing the first thing that your job is risk management.
Thanks, Mike. And I should say, to start off, it's fantastic to be here, and thank you for the opportunity to join you and your listeners. And I also want to say that I love your new format. Like a great many people, I think the content is even better and more on point than it ever was. But thank you. 2022 was a terrible year. We were at your conference in 2022 at the beginning of the year. We were also at your conference in 2021 and years before that. But in those 2 years, I did talk about raising cash inside of portfolios, decreasing exposure to the potential for inflation. And that was absolutely critical in terms of what the results were at the end of this year, because in both cases, we saw an impending problem that was going to strike, which was going to be inflation, which was going to be economic inflation. Previous to that, we had asset inflation, where stocks went up, real estate went up, all these different asset classes rose. But we knew that it was eventually going to bleed into the economy, and prices of everyday household goods were going to go up. And as that happened, we knew that was going to impact the market in a negative way, and so we were well prepared for it. But 2022 was a terrible year, and I think it's important that people understand where financial performance comes from, and mathematically, the amount you lose in any particular year has a far greater impact on your long-term wealth than how much you may gain in another year. And I think this is really important math for your listeners to understand. And this is what all institutional investors know very well. And that's, if you lose 50% of your money, it takes 100% to get back to zero. So, even if you get a 7% growth rate, that's going to take you a decade, Michael.
Yeah, well, and it's funny, Victor Adair as a trader and me as an investor, I'm more longer term investment. I don't have the emotional makeup to be a trader, but we all both talk about that for that very reason. And unfortunately, I talk about it through experience as opposed to something I read. As you say, you watch something and you're emotionally attached to it, or taking the loss is too much emotional pain. So you watch the darn thing drop in half, and as you say, boy, that's a harsh lesson. Gee, I've got a double now. To get back to even. That wasn't the point of my investment plan, was to have to double to get to even, so I think your point's just so well taken.
Yeah. And I, most people, I think, get trapped in that. And I think we're all, for an individual investors, we're our own worst enemies, because we do get trapped in emotions. We do our best to try to drive performance by removing emotion from a lot of the decision-making process along the way.
But that's why it's, for a lot of people, and I put myself in this category. I'm old, so I've got, years of trying to learn from these mistakes, literally. And what am I learning? I'm learning how to manage that emotion, really. Essentially, buy, sell points, that kind of thing. But that's why it's better to deal with a professional like yourself, because you're not as near as emotionally attached to somebody's, all their emotions around money. I think, is it love and money? And then I realized it was money, because people divorce over money.
Yes. Yeah.
So,
well, that's right.
That's why dealing with someone like yourself, though, because you can help remove that emotion. You can't force them to do something, but still it helps to get a pragmatic view that way.
Well, that's right. And it's not just by removing the emotion. It's also, there's a process that we use. Yeah. When we build portfolio managers that even reduces our emotional attachments to the portfolios that we run for clients. Because if you have a very strict discipline process, then, and you're sticking to it on a regular basis, then it reduces the emotion of even the managers. And we manage all of our portfolios with an investment committee of 4 individuals. And so we have to sort of battle it out to make changes to the portfolio. But even there, it's inside of the confines of a strict structure, which, I can go through in a little bit. But, just looking at 2022, you can see where, emotions had the impact on the market. I mean, it was really one for the ages. Absolute mayhem out there as irresponsible government and central banks washed, their decisions washed through the economies and the markets. And I think it was only the third time in history that all major stock markets and bond markets were negative. Bonds, in fact, had their worst year on record as rates spiked. And we can certainly chat about that. But, if we take a look at NASDAQ as an example, NASDAQ was down 32% over 2022. The S&P 500, the vaunted S&P 500, down almost 20%, 19%. The TSX Venture down 40%. Global equities across the board were down 19.6, almost 20%. In fact, the best performing index was the Canadian market, and that was because of the heavy exposure to oil and gas. I mean, that's really what saved the TSX. It only lost just about 8.7 or 8.8%, so relatively limited. But look at these numbers are unbelievable. If we take a look at bonds, Canada 20-year government bonds down 33% in 2022. U.S. 20-year government bonds down 36% in 2022. I mean, these are numbers that have blown portfolios absolutely out of the water.
And that's the part that has been so difficult, this unusual thing. The sort of standard is you have bonds in your portfolio to offset when stocks go down.
Yes.
That was what was supposed to happen, provide some balance in the ultimate returns. Well, as you just said, 2022 obliterated that. You got killed in bonds, you got killed in stocks.
Yeah.
Now, let me ask you this quickly, coming back to a portfolio about stocks. Now, I know you're going to be at the World Outlook Conference. You're going to get into what, further, obviously, into this. But so would you characterize this as a stock picker's market, like much more emphasis on what stocks you're in as opposed to, if you went into 2020 into 21, just get the whole market kind of thing? You didn't have to be too picky about what you were in. Do you feel that's changed now?
Absolutely, and it completely has changed, and we as a investment management group are agnostic as to whether or not this is a beta market where you just buy the market, you buy the indexes and it goes up, or it's a stock picker's market, because we do both, and we emphasize one versus the other depending upon what sort of a market that we're going into. But there's no question that index investors were mauled in 2022. And as we come out of this, there's no easy fix. This isn't 2008 where the government rides in on its horse and throws money at the situation, artificially pushing down interest rates. That's not going to happen. There's a lot of sovereign debt issues. There's a lot of other economic problems, obviously inflation being a big one. So it's going to be a minefield, but it's also, there's a lot of opportunity at the same time that's been developed, that is presenting itself to us. And that primarily is by getting down into the weeds and selecting the right part of the market that you want to be in, and then the right individual securities that you wish to be in as well.
Give me, and I don't want to, preempt what you're going to say at the Outlook, because you'll have a little more time and more depth. Give me an example of something that you look at that sort of reflects that bigger view that you have.
For 2023, do you mean, Michael?
Yes. Yeah.
Yeah. Well, I mean, I think we've got to be careful not to fight last year's battles, and one of the issues is that inflation is the overriding economic issue that needs to be dealt with. But the truth is investors should have been terrified about impending inflation in 2021 and 2022 at the beginnings of those years, which, by the way, we did, as you know, we warned your audience about that at the Outlook Conference and in other appearances as well, too, over the past 2 years. Now, inflation, I mean, it remains a significant problem. There's no doubt about that. But some inflationary pressures are abating somewhat. Lumber, for instance, and there are others, is coming down. In June of 2022, this year, or last year rather, we saw the recent peak of inflation of just over 8% in Canada. Now it's about 6%. Now, the question going forward is, how sticky will inflation be? Labor costs are a problem. They're going to be difficult to moderate. That's going to be tough. I think that's going to be the biggest issue, in fact, is going to be overcoming labor cost increases. And a recession is extremely likely. But it's whether or not we go into a recession or not is actually less important, because the real damage has been the economy slowing from 4.8% growth to likely zero or worse if we are indeed in a recession already. So a recession, whether or not we go into one, technically is not all that important, although recessions live in the minds of individuals, and they can be exacerbated when people start to believe that we're in some hellish economic environment. But overall, the economic and market environment has changed dramatically. We're in a completely different weather system than the one that persisted from the financial crisis in 2008, 15 years ago, until very recently. During that entire period, and I think you've done well to highlight this, over speculation, bubbles, silly ideas, effectively were rewarded by the central banks with artificially lower interest rates and more printed money. But the topography from that point going forward is going to be entirely different. Now, with money having a price on it, the market is normalizing. The economy is normalizing to a certain degree. And that means that it'll become more rational, more honest, and really more Darwinian. And we don't think that's a bad thing. We really don't. So anytime there's change like this, there's going to be opportunities that present themselves. And I've heard a couple of your other guests in different weeks discuss the same concept, but it's very true. And this is the stock picking part to it. There's a large number of companies out there that have great balance sheets, that have tremendous growth prospects and are growing now. They've got good dividends, and they've fallen for no reason besides the fact that they're simply stocks to 10, 20, 30, 40% below what a normalized valuation would be, and in a normalized environment. And that's going to pay dividends by adding them now. So deployment's going to be key. Ironically, we've underheld bonds and restricted the model portfolios because of all of the risks with bonds. That's why I've hated and screamed about 60-40 portfolios and the idiocy of those things over the years. But bonds and preferred stocks and other yield vehicles look interesting for the first time to us in well over a decade. So there's some opportunities there. There's no question. Energy still looks strong. Oil and gas energy. I'm talking about real energy, not intermittent energy. New and emerging opportunities are being developed in AI, and nuclear energy at this point is beginning to look extremely interesting to us. So we're looking forward to discussing all of those things at the World Outlook Conference in a couple of weeks. But I want to say one word of caution here, Michael, is that there's a lot of well-known growth companies that we've all heard of. You look at Meta, Facebook, Google, Netflix, Shopify, Bitcoin. A lot of these things are down, 40, 50, 60, it's 70, over 70% in many cases. And people have to understand that the economics suggest that we could still get cut in half on those positions from here going forward. With money costing a significant dollar amount, profits just not being generated, you could lose another 50% of your money by buying those stocks. So that's a critical issue.
I'm really glad you're putting that up, and I've been thinking about the environment we're in, but yeah. It's a better time for people like you. It was not somebody with expertise environment, because you could throw a dart at any aggressive tech company that had no earnings but promised that they were going to get to Mars, mine it, and refine it, and yes. Anything went. And I always felt that was a more difficult environment for me personally too. That people ask me, am I a buyer of some tech stock that's already tripled or quadrupled or even gone even further? And I'm going, there's no analysis that supports it. So I don't know what to do. So I think it's actually come to a time when people can display their expertise when it comes to understanding the markets. As you said, the world's changed, you should change. Understanding the specifics of stocks that are going to have a better chance, as you say, understanding their balance sheet. So I'm looking forward to it at the World Outlook Conference, because there, could you pick a better time when I could say there's food for thought? We have had this, we talked earlier, about oil and gas and about that whole world's changed. Well, the whole world has changed. Cheap energy's gone, cheap labor's gone, cheap money's gone. It's a stock picker's time. That's why I encourage people to come and listen to Neil McIver at the World Outlook Conference, because, as I say, fascinating time. There are opportunities, but there are things to be careful of. So, Neil, I'm going on and on, but I really want to say thank you today and look forward to hearing you at the World Outlook Conference.
My pleasure, Michael. I'm so excited. By the way, the lineup that you guys have organized is fantastic. The speakers are unbelievable. I think the best year ever. So we're incredibly excited to be there and to share our thoughts with everybody. But we're also excited to be there as participants listening to what others have to say. It's going to be fantastic.
Well, just remember, Neil McIver is founder of McIver Capital Management at CG Wealth. Neil, thank you.
Thank you.